we help people learn. Let the
Fantastic.
market take you in. It's unlikely to be the key moment right now, even though you're hyped and it doesn't feel like work not to trade.
Fantastic. Francis, that is actually brilliant. And not only that, I can see that you got the visual representation of actually your potential downside and your potential upside. And a lot of people actually don't do that.
So advice generally is money management for new and intermediates. So the key thing with why I illustrated the green and red item on TradingView, and many should have that, is that you highlight your trade. The concept I will just illustrate with this particular trade that is my chosen trade. I'll just put it behind the price action here, is that for me, I really get excited by disproportionate potential rewards to stops. This is actually a late entry to this market, but even still, it is lots of green and restricted red. So by keeping your stop fairly tight, you get more losers. This is something you have to determine for your trading style. You will get more losers and the game is quickly over. So I don't like long periods of pain with deep stops, but in the name of hanging on to something that is clearly indicating to you that you're probably wrong. So, and you wake up every day and you've got to look at this red number glaring at you and bleeding you out. So to be taken out quickly and to have disproportionate gains once you're on a winner, to ride the winner. And the most really successful traders are not in very long. They're losing traders. Their average hold time is very low on their losers, and their win time on their winners is long. So
That's
this
fantastic.
usually points to disproportionate gain to risk. So the key thing is you've got to know the sizing of damage that amount of red movement will cause your account. Amazingly, this actually calculates it for you versus the potential gain. This as a risk reward is around 4.5. Had we been earlier, it would actually be more like this, and even more attractive, and you would see the RRR. So I encourage people to use this and to know what they've written the check for. You never go bust taking small sized losses that you already account for that are within a percentage range of your account. The single event bad trade where you've not put in a stop is where you get hurt. And actually stops work against you in most instances. So you have to choose those moments where really tight stops are not scalping losses for you, but that you have a slugger's chance of getting away. So the best trades move normally quite quickly away from your entry so that you immediately end up with more buffer. And hence why you shouldn't use market orders. Let the market take you in. In other words, part of the confirmation of that move is happening. So that's a little bit of foundational knowledge. It's based into what we call the Hunt Volatility Funnel Method on the marketsniper.com. And that's what we help people learn. Let the market take you in. It's unlikely to be the key moment right now, even though you're hyped and it doesn't feel like work not to trade.
Fantastic. Francis, that is actually brilliant. And not only that, I can see that you got the visual representation of actually your potential downside and your potential upside. And a lot of people actually don't do that. And funny you say that because, as I mentioned, I am in the broking side of things. And, you know, I get to see a whole heap of different things these days. Generally speaking, clients or traders do quite opposite. They hang on to their losing trades and they actually take small profits on their winning trades. And what it does then is actually rationale is out of the window. They can't think properly, and then trying to compensate and make up for those losses, and that just leads into a spiral. That is fantastic, Francis.